The stock market has exploded in the past year and it has made a lot of investors some sweet and juicy dollars. Even with rising inflation, supply chain issues, labor shortages, and a failing real estate mogul that we still don't completely understand the impact from, the stock market has been reaching new highs and stays in the green pretty much every single day. With double-digit returns in the S&P 500 in 4 out of the last 5 years, it really makes you scratch your head about the sustainability of such returns over the long run, and at least for me, it makes me anxious about what the stock market is going to look like by the end of 2022. There is a lot happening in 2022 that may significantly alter the course of your portfolio and may put it either significantly ahead or ways behind from where it stands at the end of 2021. As such, it is extremely crucial to have a relatively safe investment strategy that can protect your assets in the event of a market downturn or an unprecedented market collapse. As Benjamin Graham, who was widely considered the father of value investing, once said, successful investing is all about managing risk and not about avoiding it. And that is why on this channel we focus more on value investing that will safely make you and I a millionaire one day, and not on YOLO investments that may drag your portfolio down to zero overnight. But before we jump into my investing strategy for 2022, please make sure to hit the like button below and subscribe to my channel for more personal finance videos. Over the Christmas break, my wife and I reviewed our investments for the past year to understand what strategies worked best, what investments provided us with a good return on our money, and it helped us assess our path moving forward into 2022. Of course, as I have mentioned in my previous videos, about 90% of our combined portfolio is invested in the S&P 500. And don't get me wrong, 2021 has been a great year for the market index itself, as well as for both of our 401k accounts that are invested 100% in the S&P 500. The S&P 500 ended the year 2021 at roughly about 27% up from the previous year, and same is the case with our 401k accounts that are roughly perfectly tracking what the S&P index is doing. For 2022, both of us are planning on maintaining the same strategy as we did for 2021 as far as our 401k investments are concerned, and we plan on building that portion of our portfolio further. As far as the contributions go, IRS increased contribution limits to 401k accounts from $19,500 in 2021 to $20,500 in 2022. We definitely plan on taking advantage of this opportunity to save some more money on taxes over the next year. The next account we have that we both contribute after-tax dollars to is our Fidelity Joint Brokerage account. For our Fidelity Brokerage account, once again, about 70% of our portfolio is allocated to S&P 500 Tracking Index Fund. With these, however, we failed to perfectly manage our investments in 2021, and even though the market performed about 27%, our investments were only up about 18% for the year. We did a deep dive into why that would have happened. Turns out that dollar cost averaging is a far superior method of investing, at least for our situation, than lump sum investing when the market dips. What happened was that we ended up investing more money during Q3 and Q4 of 2021 rather than Q1 and Q2 of the same year. So we bought more stocks in Q3 and Q4 of the year, and even though they were bought at higher lows and during relatively major dips, their cost basis was still higher than lower highs for the same stocks in Q1 and Q2. I don't know if that makes sense at all, but please definitely leave a comment down below if you still have questions about this, and I will try my best to clarify further. Moving forward for 2022, we have decided to dollar cost average into our brokerage account every couple weeks, starting the first week of this month, so that our investments get averaged out with market returns throughout the year. And finally, the third major class of accounts each of us has is an individual brokerage account with Robinhood and an individual crypto account with Blockfi. Our Robinhood accounts are where we separately pick individual stocks depending on what we think is going to perform well over the next few years, and our Blockfi accounts are where we separately invest in cryptocurrency as and when spare money is available, or when cryptocurrency slides by 10 to 15%, which is pretty much every single month. For 2021, there was a point in time when my Robinhood account was almost beating returns from the S&P 500. However, as the Feds announced changes to their monetary policy, all the high-risk stocks in my Robinhood accounts checked out for the year and started relentlessly falling, causing my Robinhood account to end the year at a negative 22% return. I guess I failed to beat market returns after all. I have decided that it is more efficient to just invest most of our money in S&P tracking index funds, even though I enjoy the occasional challenge of picking and analyzing new stocks. Losing money and seeing red for several weeks at a stretch is not as much fun, and I would much rather be better off with a different hobby, like playing the guitar, for example. However, I'm going to increase my contribution towards my Blockfi account in 2022, and I will start buying Bitcoin more regularly than I did in 2021. And the second important thing I will be working on this year is buying and tracking dividend stocks. I am a big fan of dividend stocks as the returns are somewhat fixed compared to what growth stocks can offer, And if you would like to be a part of my dividend investing journey, definitely consider subscribing, as I will be sharing all my dividend stock investments with you going forward, and I will also be making videos to help you understand what dividend stocks are, how they work, and how dividend stocks can help you achieve financial independence one day. I know there are other riskier assets such as NFTs and metaverse out there, but I'm going to stick to the more traditional methods of investing for the most part and take advantage of what is known as the efficient market hypothesis, that states that over the course of the long run, it is almost impossible to beat returns from market indices for an average investor. Thanks so much for watching, guys. I really appreciate it. And as always, please don't forget to like this video below and subscribe to my channel for more personal finance videos. Also, if you are tired of just watching me in this small frame, please follow me on Instagram as well as on TikTok, where I share spicy insights of my personal life and how I save money pretty much on a daily basis. Alright everyone, see you guys again soon. Thanks so much for tuning into my channel.